Welcome to this personal tax roundup for this month. My name is Dean Wootten. First up, we're going to look at a case concerning PAYE repayments, and this was James Stuart Bailey. Now, Mr. Bailey worked in the mobile phone industry, and he was falsely accused of being involved in MTIC, missing trader fraud, and he was in prison for a short while before being acquitted. Now, in 0304, earnings of just over £2 million were credited to his director's loan account with Bailey Limited. Now, this was supposed to be his net earnings, or his net bonus. Now, he claimed that the gross was about 4.4 million, and obviously PAYE national insurance deducted, with the net being credited to that loan account. The company was put into receivership, and HMRC's final proof of debt against the company did not include the disputed PAYE liabilities. We'll see that the PAYE that was supposedly deducted and paid over to HMRC on this amount, this 4.4 million, wasn't actually paid over. But it wasn't on that final proof of debt against the company. Now, Mr. Bailey invested in film partnerships and legitimately claimed tax losses of 3.6 million. They weren't disputed. Now, in 0304, his available partnership losses covered the whole of his income for that particular year. And believing that that PAYE had been paid over to HMRC, he sought to reclaim that PAYE. HMRC had not included that debt for PAYE in the liquidation, so as far as Mr. Bailey was concerned, it had been paid over. Now, HMRC subsequently argued that PAYE had not been paid, and the advisors of Mr. Bailey confirmed that it hadn't been paid. Now, while the losses in the partnership were available to be offset against other profits, they could not be set against the PAYE-related earnings, as the PAYE had never been paid over to HMRC. HMRC therefore reduced his earnings to the amount credited to his loan account, i.e. they were saying, well, it's not your net pay that's gone there, it's your gross pay. And that was covered by the film losses. So there's no tax to pay, but obviously he's got losses of 3.6 with gross pay of just over 2 million. Now, Mr. Bailey therefore appealed. Now, the only evidence provided of the PAYE payment having been made to HMRC was the accounting entries in his director's loan account, the net being posted there. And the tribunal stated that in the McVeigh decision, the mere entry in the accounts of a company is not sufficient to amount to payment of that PAYE. In order to succeed, Mr. Bailey must show that the payment was physically made to HMRC, and he couldn't prove that. So unfortunately, the HMRC approach stuck, and the appeal was thrown out. Next slide, we're going to look at the high income child benefit charge and discovery assessments, and this concerned Jason Wilkes. Now, Jason Wilkes had not submitted tax returns as his income was fully taxed under PAYE. However, he had earned more than $50,000, and his wife had been receiving child benefit, so your classic high income child benefit charge. Now, following up on an HMRC nudge letter received in November 18, Mr. Wilkes established that he was liable for the high income child benefit charge. And HMRC issued discovery assessments to collect the sums due for the tax years 14-15 through to 16-17. Mr. Wilkes appealed and was successful at both the first tier and the upper tribunals. The legislation allows HMRC to assess income that ought to have been assessed, but did not allow discovery assessments to be used to collect a tax charge, such as the high income child benefit charge. HMRC appealed to the Court of Appeal. Court of Appeal agreed with the upper tribunal. The high income child benefit charge was an unpaid tax charge. It wasn't untaxed income. And Mr. Wilkes had been correctly taxed on his income through PAYE, meaning that no additional tax was due on his income. And therefore the discovery assessments were invalid. The Court of Appeal stated that it was not its role to amend the legislation to enable HMRC to collect the high income child benefit charge, so HMRC's appeal was dismissed. Now, as I'm sure you know, HMRC have subsequently changed the law, so they can now issue discovery assessments in this instance, but the change does not apply to appeals made before 30th of June 2021. So the subtle point on this case was the discovery assessments. Previously, they could only be used for untaxed income rather than the tax charge. That has now been changed, so they could now issue discovery assessments in this type of situation. Next up, we're going to look at a personal liability notice to collect national insurance from what was the company, but shifting to the director. Now, Mr. Wagstaff was the sole director of Warehouse Holdings Limited, and the company deducted income tax and national insurance from its employees' salary. But the company had a rather checkered compliance history. It filed its P35 return for the tax year 9-10 on the 20th of March 12, almost 2 years after the deadline of 19th of May 10, and it declared a national insurance due of just over £13,000. It failed to submit its P35 returns for 10-11 to 12-13. It failed to submit monthly RTI returns for the tax year 13-14. And between June 12 and October 13, the company made payments to HMRC totalling just over £22,000, but failed to pay any further sums for 9-10 through to 13-14. So a rather checkered history here. Now, on the 20th of November 15, the company entered into a creditor's voluntary liquidation. In October 16, HMRC submitted a proof of debt to the liquidators that included a claim for unpaid national insurance for the years 9-10 through to 13-14. On the 13th of March 19, on the basis of the company's failure to pay national insurance arose due to Mr. Wagstaff's neglect, and that's the key for these personal liability notice, the HMRC issued a personal liability notice for the unpaid national insurance plus interest of just over £300,000. Now, Mr. Wagstaff argued that under Section 9 Limitation Act 1980, the NICs were subject to a 6-year limitation, and the NICs prior to the tax month ending 5th of March 13 was statute barred by 13th of March 19, when the personal liability notice was issued. Now, the first year dismissed Mr. Wagstaff's appeal against the notice, finding that the personal liability notice was not time-barred. This went up to the upper tribunal. Now, when a company enters into a creditor's voluntary liquidation, its unsecured liabilities are inevitably in and to be determined within that liquidation. There's no other regime that applies to determine the existence of the company's liabilities and their enforceability for limitation purposes. So what that meant was that the 6-year limitation period did not apply. And the upper tribunal concluded by saying there's no inherent unfairness in the culpable director remaining liable so long as the company is still liable. And in any event, limitation periods are often extended, for example, if the debt is acknowledged. Furthermore, when the company is dissolved, it is no longer liable to pay the NIC, so a penalty liability notice could not be issued. And when the penalty liability was issued, the company was still liable as the voluntary liquidation was not completed. So unfortunately for Mr. Wagstaff, the penalty liability notice did stick. It stuck because when it was issued, and they had a right to issue it, it wasn't time barred, it was because of his action. Yeah, when it was issued, the company was still liable. The liquidation is not yet completed, so therefore the notice did stick, and he was liable to the national insurance penalties. Next up, we're going to look at SDLT and grazing land and woodland and whether it affects the residential rates or the mixed rates. Now, Mr. Withers and his wife bought a dwelling with an independent annex for £2.5 million, and it also had 39 acres of gardens, fields and woodlands. Now, the SDLT return was submitted on the basis that the property was mixed use. Some of the land was used for sheep grazing and for cutting hay, and further land fell under the Woodland Trust rewilding scheme. And that's why this case is important, because it's a property, obviously a very nice property, with a lot of land. And you look at the use of the land and seeing if that affects what rate of SDLT should be applied. Now, as a side point on this, the couple also claimed MDR, but I don't think that's the main point on here. The point is whether the grazing and rewilding land was regarded as part of the dwelling, so therefore only dwelling rates would apply. Now, the grazing land had been used for that purpose for around about 20 years, and the rewilding land was used by the trust for some time as well, and there were very strict conditions regarding access and use of that rewilding land. Now, this went to the first tier in the end, and the first tier said, look, to qualify as mixed-use land, the land needs to have a function other than garden or grounds of the main house. Now, grazing agreements and woodland trust agreements were in place at the time of purchase, And with that grazing land, the grazing land couldn't be seen from the house, it was very separate, and the rent of £800 per annum was lower than market value, but the farmer that rented the grazing land had maintenance obligations of that land and its boundaries and fences, etc. A feeding station and water troughs demonstrated that land was used agriculturally, and the first year thought the grazing land had a separate, self-standing commercial function. Under the rewilding agreement with the Woodland Trust, the Withers were responsible for 50% of the relevant costs and had an obligation to control rabbits and prevent animals grazing on that land. And the first year thought that the function of the woodland was improving the environment and rewilding. So the tribunal thought the purchase was of mixed use. It was a house and some commercial or non-residential land, and that's mixed use. And the SDLC saving was around about £98,000 on this. So it's quite an important case as to whether you buy property with a lot of land, what is that land used for? And it can reduce your SDLT by a significant sum, because if it's mixed use, then the non-residential rate's far lower than the residential rates. So sticking to SDLT, we're going to look at Mr. Daniel Ridgway. Mr. Ridgway wanted to buy 2 adjacent properties with separate titles and land registrations, and one had been previously as an artist studio. Now, he was taking advice on how to reduce SDLT, and that enabled him to increase his offer price. So he obviously had a budget, and within that budget was SDLT. So if it was less SDLT, he could afford to pay a little bit more. Now, under HMRC's guidance, his purchase would qualify for mixed-use rates, obviously lower than residential rates. SDLT is assessed on the basis of use at the time of purchase. So if there's a genuine arm's-length commercial tenancy, there should be mixed use rather than residential. So the commercial tenancy, in this case the artist studio, hopefully makes the purchase mixed use, which gets lower SDLT rates. Now, prior to the purchase, he signed a commercial lease with a photographic studio for 9 months, and this prohibited use of the property as a dwelling, and further subletting was not allowed. Now, with that lease in place at completion, Mr. Ridgway claimed mixed use relief, i.e. non-residential rates. Now, HMRC stated that guidance did not have the force of law. HMRC preferred to apply their latest thinking. Now, despite not being used as a dwelling at completion, it was suitable to do so, and therefore the residential rates applied. HMRC's current guidance reflects that thinking. HMRC denied multiple dwellings relief, although the taxpayer would have been eligible for the relief. The claim was not made in the SDLT return, so they ruled that it was residential, but because he hadn't claimed MDR on the return, he couldn't get it. Now, this went through to the first tier. Now, the terms of the commercial lease and the consequences of breaching those terms made the property not suitable for use as a dwelling at the effective date. So it starts off by looking encouraging, but Section 75 of the Finance Act 03 has some anti-avoidance provisions, and these anti-avoidance provisions means that mixed-use relief is going to be denied here. Now, Section 75A refers to anti-avoidance, and this section applies whether or not there's a tax avoidance motive. All that's required is that lower SDLT is payable because of the scheme transactions. Now, Mr. Ridgway entered into the commercial lease to reduce his liability to SDLT, and because of that, that's Section 75A, and the lease was ignored. The notional transaction that had taken place was simply the sale and purchase of the properties. Mixed use was denied because of the anti-avoidance provisions, but the tribunal said they thought the MDR was available. There's no statutory requirement to make a claim in a land return or an amendment to that return. So I guess the important thing from here is that he put steps in place to try and trigger mixed use, but the purpose of that step was solely to trigger the mixed use provisions, and that would introduce the Section 75 provisions of Finance Act 2003. Let's now look at an IR35 situation. Well, it was an IR35 situation, but didn't get that far. Now, Michael Liner is a former Australian professional rugby player, a rather good one, and I think he's been voted in the top 50 rugby players of all time. He played for Australia for many years. He was captain for a while. He's currently employed by Dow Jones Corporate MEA, and he's also a rugby pundit for Sky Sports. He does that through his personal service company, MPTL Limited. Now, HMRC were focusing on his personal service company, and they challenged the tax treatment of the service provided through that company, arguing that that's IR35, and they raised assessments to collect some $230,000. Now, HMRC sent a letter that upheld the application of IR35 and the determinations and the decisions. And they said that if you want to appeal it, then you appeal it. But your appeal must be made in writing to the first tier tribunal within 30 days. Now, the agents notified HMRC within the time limit, but failed to notify the tribunal. The new agents discovered this error and applied for permission to make a late appeal to the tribunal. Now, the first tier considered the threefold test laid out in the upper tribunal decision of Martland. The first step, how late was the appeal? Well, 59 days late. It's sufficiently long to be considered serious. What was the reason for being late? Well, unfortunately, there was no good reason for the late appeal. HMRC's letter was clear. The agents were a professional firm. They should have known better. It's a very costly mistake, this one, for Mr. Liner. Not his fault. It's his previous advisors that were advising him. It's their fault, really. Circumstances of the case, well, the case was sufficiently strong, as outside of his pundit role, Mr. Liner worked as an employee for Dow Jones, and he had no other self-employment activity to support his case. So it looks like the only income going through his personal service company was Sky Sports. So the first tier didn't think there was much there, really. So the chances are, well, they felt that he may well have lost. So therefore, it's a very late appeal. There's no good reason for it. He's not got a very strong case. So unfortunately, the application for the late appeal was dismissed. So it looks on the face of it quite costly, $230,000. But saying that, would he have won? We don't know, because obviously he's not allowed to appeal that. That concludes the personal tax update for this month. My name is Dean Wootten. Thank you for listening.